All right, so I'm down pretty bad, like more than 20 grand bad with Opendoor and Offerpad. These iBuyers were names that I was holding on to during the market drawdown with some conviction because I believe the reason was there. I believed in the model and they were proving it with their numbers. But you know, despite me getting rid of a bunch of other growth speculative names, I kept these, and now I'm questioning this after Q3, more specifically their guidance. So that's something I want to take a deeper dive into and take you along with my analysis. Hope you enjoy the video. If you're not familiar with the iBuying model, then I suggest you take a look at my previous video, which I'll link above. But in any case, I'm going to play some clips on that just to get a little bit of a refresher in terms of the model and what they do. Before I do that, however, my name is Bill Hawk. For the people who are new here, I generally talk about investing on this channel. I'm just a random guy talking about his own journey. I'm a full-time operator turned investor, so none of this is financial advice. If at any point in this video you receive some value, I'd appreciate it if you hit the like button and subscribe. It helps me out with the YouTube algorithm and helps me reach more people, and as you can see, I have a lot of growing to do on this channel. Before we dive into the business model for iBuyers and Opendoor, let's take a look at the traditional real estate model and just basically revisit it. So let's say you want to sell your home. The first thing you're going to do obviously is find an agent, and then you're going to have to do some repairs and prep the home. You're going to list the home, let's just say in this case for 250 grand. You're going to have to host several open houses or showings to prospective buyers. Then you're going to receive an offer for 240. So they're obviously going to try to lowball you. You're going to negotiate some repairs. You're going to find a new home. Then in that case, the buyer's going to do their inspection. All this time you're going to be waiting for close. You're going to be looking for a new home, and you may miss out on your new home, your dream home that you're looking to move into. It's a pretty complicated and lengthy process, basically, when we sum it all together. If you've been through it, you know what I'm talking about. And it's also expensive. There's a lot of broker commissions, there's closing costs, lawyers, mortgage closing costs, there's all kinds of things, and the average closing cost, as you can see here, adds up to about $30,000. Enter iBuyers like Opendoor or Offerpad. They basically act as a middleman instead of an agent. They buy the home directly off the seller, they do the renovations, they fix it, and then they flip it to another buyer for obviously a profit. So like I said, the model is pretty simple. It's just flipping houses, but they're doing it based on an AI platform, making the process a lot easier. As you can see here, the iBuyer model is just so simple if you want to sell your home to them. You basically fill out a 3-minute form and you get a cash offer within 24 hours, sometimes even sooner depending on the iBuyer. You then can search their marketplace for other homes that they have vacant. You can access through your mobile app. The entire inspection and closing process is virtual, so it literally does not get any easier than this. iBuyers are just so efficient because of the AI and algorithm that tells them exactly what a home is worth, what they need to put in terms of repairs, and the after repair value, what they can sell the home for. This is all automated because of AI and machine learning, and that's the real disruption here. Then they basically make their money on that spread, so that margin, also service fees they charge. They can also work with realtors for commissions if that needs to be done. Taking a look at a traditional sale versus an Opendoor sale, we're gonna see why the traditional sale is more complex with more parties involved, more uncertain. About 20% of deals fall through, which is a crazy high number. They're also very slow. The average days to close on a house is 87, which is also really high, and it's also just more human intensive. But for that convenience, with 0 days to market, closing date totally flexible on you, and 0% fall through, you're gonna pay in the form of a lower selling price. And Opendoor, typically, they're not gonna lowball you, but they're gonna need to make money, so they're gonna be paying you a little less than market. You can just assume that. Their fees are a little higher, so to close on a traditional sale, you're paying about 5.5% to the buying and selling agent and whatnot, and with Opendoor, it's a flat 7%. The closing costs, other than that, are the same, and there's no hidden costs with Opendoor. It's pretty clear to see why this model exists and where it provides value. The answer to that is just convenience. It's never been easier to sell your home than it is with iBuyers, and that's why they're going to continue taking market share from the traditional $1.6 trillion real estate industry that's never been disrupted. All right, now that you're hopefully familiar with the model, I'm going to get right into it and go over this valuation analysis, which I typically give in my videos. And of course, if you want full access to this, which I highly recommend if you're going to make this investment or any investment, it's available for free for newsletter subscribers, which is linked below, as well as members of the Discord, which I highly recommend you sign up, because then you can also have live conversations with myself and all the other smart people on there. So as you can see here, 2021 was a great year for Opendoor, and this is Opendoor. Revenues grew more than 200%, and my personal favorite metric for them is contribution profit after interest, which is basically how much they're earning for each house after paying interest. So this is how it typically goes. From revenue, we're going to gross profit, which is also GAAP, and it includes inventory valuation adjustments. So if the inventory they're holding, like the homes, for example, are going down in value, then they're going to be writing them down based on their analysis and valuation, which of course can be subjective, and of course market conditions can change. So from there we get a gross margin percentage, and then contribution profit is basically their gross profit minus their direct selling costs and holding costs for the home. So this is a little bit more accurate and getting closer to what I typically want to see if the iBuying model is working. Taking this a step further after looking at the margins is contribution profit after interest and contribution margin after interest, which is basically factoring in the interest cost. And I believe that this is the best number to be looking at. And you can see that they have been growing this consistently. And even in 2022, this is 9%. So this is a positive for me that they're able to make this model work even in tough market conditions. So this was all positive to me except the guidance. So you can see here they guided revenue growth to be pretty much flat year over year for Q3. And that's because they're slowing down their home acquisition. As you can see here, they significantly slowed the acquisition of their homes to 66% growth, whereas they're selling, as you can see, 400% and 200%. So they're slowing down, and this is partly because of market conditions. They're taking the more conservative approach and focusing on profits, which is the right thing to do, obviously, because the model is improving. And of course, because of that, they're forecasting adjusted EBITDA to be negative for the first time since 2020. However, I'm going to say that we don't know how the accounting impacts for this is going to be and whether GAAP net income is going to be positive, because they already took the write-downs in previous quarters. So it could be that it reverses, and the fact that they're not buying as much will prevent further losses in terms of GAAP. So this could look better, but in any case, the growth now is gone, and that's a huge negative for a company like this. Any investor is essentially buying for growth. Based on their forward guidance and macro analysis, they're positioning for the housing market slowdown by slowing down purchases and having a larger spread on the homes that they're offering again. So this is going to be the ultimate test to their model, and I think they're doing a good job, but it's impossible to say how, when, or if they turn things around with the housing market, which leaves us with analyzing the macro ourselves to determine whether this is an attractive place to start buying. So I'll get into that in a little bit. But before I do, I just want to say that previously in my previous video, I valued the company based on an assumed growth rate, but I'm going to say from here and in this point in time, it's impossible to do reasonably. So I'm not going to sit here and pretend like I can do this, because literally nobody can. So what I'm going to look at is price to book. And you can see here right now, Opendoor is trading at a price to book of just above 1, which you can say is attractive. But again, we can't just jump to that conclusion. We have to take a look at some other factors. For example, what is Offerpad trading at, which is about the same. And if you take a look at Offerpad's numbers, which are down here, their metrics are pretty much identical in terms of how they're slowing down growth and actually their contribution margins after interest. The model looks pretty much the same. Before, I was seeing some discrepancies in here, and I believe that Offerpad was focusing more on profits, but I can't say the same now, which leads me to say that Opendoor is a better company to buy because they are going to be the market leader, which you can see here in terms of homes they're buying. Offerpad's bought about 3,000 in the last quarter, whereas Opendoor's bought 10,000. So I'm going to go with the market leader. But I don't know what happened to Offerpad's stock. It just took a massive dump in June, and it's recovering, but I don't know, was this a sponsor selling? Probably, and that's probably why these SPACs are getting such a bad rep. But insiders at Offerpad are actually buying, which is contrary to what the insiders at Opendoor are doing, so I find that quite interesting. But in any case, the valuation is about the same. So you might be looking at these numbers and saying, okay, well, I'm just buying the real estate for what it is worth right now, according to their valuations, and I'm getting the business model for free, the iBuying model. But wait a second, because before you do that, you want to take a look at what single family home REITs are trading for against their NAVs, because essentially that's the book value, and they're trading right now at an 18% discount to NAV in terms of US single family REIT, which I believe is really attractive. So you got to ask the question, why am I going to pay full price if I can get an 18% discount, which is potentially factoring in for additional 18% downside in the housing market? So I'm going to get into REITs in a little bit in the end of this video, but let's take a look at some macro analysis I did previously on my TikToks, which if you're not following, by the way, make sure you're following, just to understand where the housing market is potentially going. And of course, this is just my opinion. The housing market is at least that's what some of the data is suggesting. The most concerning piece of data is new home supply, which you can see is near 2008 levels. The existing home supply isn't anywhere near that, which is good, and I'll explain why. But new home supply and new home builders are going to be hit, and that's what's going to have the most trickle effect in the economy. It goes something like housing, orders, profits, and then employment in that order. So it's very clear that we're on the path to a recession. The reason why households may be able to hold this time as opposed to 2008 is because the household debt to GDP, if you take a look at it, is nowhere near 2008 levels, and delinquency rates are actually going down after COVID, and most people now are on fixed rates rather than variable rates. So no, I don't think this is going to be a great financial crisis part 2. But when you have quantitative tightening at unprecedented levels in recent history and mortgage rates going up as fast as they ever have been, other than maybe 2000, which isn't a great benchmark, you're going to have a correction and you're going to have a slowdown. And that's why I believe this is going to be a good opportunity for the people who have been on the sidelines to achieve home ownership should they choose to. So there's been a lot of talk about this, and the primary bear thesis is a potential credit crisis or an affordability crisis because of the high debt levels and obviously higher rates. Now, there's also a bull case because of lack of supply. So I'll go over both of those in this video, and then I'll also give you data points on what real estate typically does in a low growth, high rate environment. If you use a 30% threshold for the cost of home ownership, which I think is very reasonable as quote unquote affordable, then you'll see that with current rates at about 5.5%, only cities in California become an issue. Whereas the more popular cities in like Texas, for example, they're fine. And I don't think it supports the case that it's going to collapse. But of course, there's the counter argument that the cost of food and energy are going to keep rising. But I do believe that we've reached some sort of peak inflation and peak rates. So there's an even more bullish view, which comes from the lack of supply, coming from the historically low vacancy rates. But there's a counter argument to that not a lot of people are talking about, other than Elon Musk, for example, which is the lack of population growth. People just aren't having kids, and that's something that's needed to grow demand. The only thing that makes up for that is immigration, and that's where countries like Canada, for example, do a much better job than the US, whereas about 60% of their immigration comes from skilled workers, and honestly the US has a lot of catching up to do in that department. Irrespective of all that, you'll see that real estate actually performs positive returns about 80% of the time or more during rising rate environments, which also outperform equities. So the real opportunity is really public REITs, which historically they trade at a premium, whereas right now they're trading at about a 5% discount to NAV. That can get more, and I do believe that's where the opportunity will lie. Basically, to sum it up, I don't think we're going to have an 08 style crash in real estate because consumer debt is nowhere near as high. However, public debt is pretty damn high, and that's a big problem, which is of course going to have its impacts in real estate and globally, but I don't think real estate is going to be specifically targeted or impacted compared to 08. So I believe that the market right now is already pricing in discounts that are similar to 08 and 2000, and we can take a look at this by looking at the REIT discount. On average right now, the US REIT is trading at an 18% discount as of August 31st, which is an insanely low number. Previous crisis lows included 22% at the end of the dot-com bubble, 17% in the great financial crisis of 08-09, and 15% during the taper tantrum of 2013. And just for some context, had investors purchased REITs during these three periods, their 12-month forward returns would have been 16%, 85%, and 19% respectively. So obviously, it's a good time to buy unless you believe 2000 is going to be the base case, which it isn't for me. So I think it is a good time to consider real estate, which is at a discount, which it is in the public market. So to try and answer the question as to whether I should sell, take my losses and move on, or whether I should hold because right now is a good buying opportunity, I honestly don't have the answer to that question because it's impossible for me to forecast what the future of iBuying is going to be. Was it just hype? Is it going to be a failure? Is it a failed experiment? I don't know because it's impossible for me to forecast the future. So the only thing I'm looking at is price to book. But it's hard to argue that you're not getting a better deal with REITs because they're trading at a discount to NAV instead of a 1-to-1 against book value. And there is no growth. So you can't argue that, okay, these REITs don't have growth because there's literally right now no growth in terms of Opendoor or Offerpad. Will there be going forward? Yeah, but I might as well wait for it in my opinion. Of course, you can't compare the two because one is also giving you income while you're waiting and one is giving you potential capital gains. But if I'm going to hold or buy something during an uncertain time, I'm going to want some income to be compensated and I'm going to want to buy that at a discount, which is what REITs are offering. So I just believe the risk-reward ratio is much better there in terms of real estate exposure. If I'm looking for real estate exposure, I think it's very clear that REITs offer a better risk-reward right now. So I don't know, what do you guys think? Should I keep holding Opendoor and Offerpad or should I just sell and move on? Let me know what your comments are, and again, if you like this video, please hit the like and subscribe button, and I hope to see you on the next one.